I'm Dan Johnson from the Stamford office. When we were handing in our slides for this, and one of my colleagues looked at them and she said, Dan, it's not clear to me what the top 10 challenges are based on your slides, and I didn't know that we were numbering our challenges, so I apologize for that. But it brings me to my first point, which is communication within a business. It's important to be talking to your partners, and as advisors for us to recognize when partners are not talking to each other, and to recognize in the family context that frequently they're talking to family members who are not part of the business, and that can have a destabilizing impact on the business. So when we are working with a family and business owners in particular who are acting as partners, and we want to get them together to talk about important business decisions, it's important for us to recognize the dynamics of the family as they relate to the business. The second value that we can add for our clients, aside from giving clever technical advice, is getting them to talk about hard topics. I always say, as a trust and estates lawyer, the first hard conversation you frequently have is about guardianship decisions, where you're sitting with a young couple and you say, okay, have you guys talked about who's going to be the guardian? And the husband says, yeah, I always thought it'd be my brother. And the wife says, your brother? And that's where it's time to back away from that conversation and move on to something else and let them talk in private. That's nothing compared to a business that is nurturing an heir who's probably not qualified to lead the business. And it's not my place to make that judgment, but it's my place to identify the issue if it's not percolating already within the family. And so that's value we can add, is saying, having somebody who's not qualified to run the business, it's bad for the family, it's bad for the business. I recognize, we all have to recognize bringing outside talent to manage the business can have a destabilizing impact on the family dynamics. And so that's a known issue too. But we have to do what's best for the business, which ultimately is what's best for the family. Business owners tend to, because they are entrepreneurs, because they are salesmen, because they're enthusiastic, they tend to be emotional about their businesses and ascribe value that's sometimes not there. I was working with a business owner a couple of years ago who ascribed a value of $20 million to a number of businesses that he was involved in. And then we had a health event where we had to really value them. They were worth about $2 million. You want to be realistic, and that, my original proposed topic was the top 10 things you need to know about traveling in Cuba. But that got shot down as not taxi enough. But I did go to Cuba this year, and in preparation, I knew nothing about Cuba in advance. So I read this book, The Bacardis and the Long Fight for Cuba. And it's an interesting book about the Bacardi family and how they managed to bring their business offshore in advance of the revolution, and how they've transitioned. It's still a family-owned company, which is amazing, worth billions of dollars. But now they have transitioned to some non-family management. Now, unfortunately for me, in this case, the Bacardis, this company existed for 170 years and became a multi-billion-dollar company. But in 2000, they did appoint the first non-family member as CEO, Ruben Rodriguez. And though the book says, though he's a native Cuban, Rodriguez was the first company chairman from outside of the Bacardi family, and he was less emotionally connected with the company's Cuban history than his predecessors had been. With his background in financial analysis, he was also mindful of bottom-line concerns. And that comes up in the context of they were doing some lobbying that was costing the business a lot of money, and it was emotional lobbying based on an issue related to Cuba that the Bacardi family felt strongly about, and he eventually backed them away from that position as a business decision. And that was something that was easier for a non-family member to do. When you're working with these families, it's important to talk about their objectives. It's incredible how often you'll run into a family that has started a business that has turned into a successful business over time, and the documents have not kept up with their wishes or the scope of the business. It's important to sit down with business owners and say, okay, if you pass away today, what's going to happen to the business? Who's going to have your shares? Who's going to benefit from your shares? Who's going to have the voting rights for your shares? And have those hard conversations that lead to frequently very simple documentation, but documentation that keeps up with the wishes and the intent of the business owners, and make sure, again, that they haven't outgrown their documents. Part of this is an estate liquidity analysis, saying, okay, if something happens to you today, you have an interest in a very valuable business, how are we going to pay the taxes? If there's a 40% tax on your shares, and we all, of course, in light of the exemption, we know the tax is not going to be maybe from $1 under the current regime, but there's going to be a big tax bill to be paid. It's due 9 months after death. How are we going to pay it? Are we going to put it on extension? Is there going to be a sale? Do you have liquidity set aside in other places? Is there a role for life insurance to play in this? Are we going to sell to other partners? Are we going to enable or potentially consider a sale outside of the family if it's a family business? So we have to frame all of those issues which I call the soft issues, I do want to talk about one technical issue. And when you do what we all do for a living, this is a good piece of cocktail party conversation. And I know it's always exciting when a tax lawyer puts up a section of code 2 hours into a meeting. But Section 2036 is a good one to have on your radar, and it explains a lot of things we do and probably a lot of the rules that you all know. And what this section says is that to the extent that a decedent has made a transfer of property, those assets can be included in the decedent's estate at their death if. And the first thing is they've retained possession or use of those assets. And you all know this rule intuitively. You see it when when a Cupert is successful, and now the Cupert has exited the term of the trust, and now the person who funded the Cupert says, I still want to live there, and we're saying you have to pay fair market value rent. The reason is we're defending against 2036A1. We're saying you can't have free use of that property, otherwise we have a 2036A1 problem. Second example that you all know is with insurance trusts, if the spouse is the beneficiary of the trust, we're always saying, when you pay your insurance premium, use an account that's only in your name, not a joint account, not your spouse's name. We don't want a spouse making contribution to a trust where they're a beneficiary. That's a 2036A1 problem, right? Probably resonates with everybody. So what's the defense against that? Give away assets to a trust where you're not a beneficiary, right? Don't retain use of or control over those assets. And so that's why a lot of business succession planning, you see property going into a trust where the person making the gift, the person who founded the business, has no interest in that trust on an ongoing basis. The second piece of 2036 is you can't have voting control over distributions of the asset that you've given away. And so where you see that from a planning perspective, if any of you have worked on Delaware dynasty trusts, where we say to the person who's setting up and funding that trust, you can be the investment advisor of this business still. You can still have control over how these assets are invested. Presumably we're in Delaware, we're using a Delaware trustee, but you need somebody else has to be the distribution advisor. We're going to cut off your rights for 2036A2 purposes, and somebody else is going to say when assets are coming out of this trust. Another thing that you'll see in planning is some attorneys will say, if we're going to do, for example, an installment sale, we're going to layer the same concept into a limited liability company. We're going to say this limited liability company, you client, business owner, you can still be the manager of this limited liability company, but we're going to name somebody else as the distribution manager, and they're going to make all the distribution decisions, and that's going to protect you under 2036A2 from inclusion in your estate. Now, the other, if you're reading this carefully over my shoulder, the other defense against 2036A2 is except in the case of a bona fide sale. And a lot of these sales of business interests are happening in the context of an installment sale, which we talked about a little bit earlier. And so you might say, well, if I'm doing an installment sale, doesn't that mean I don't really have to worry about 2036A2? And the reason you still want to think about it is because of what bona fide sale has been defined to mean in case law. There's a case, the Bongard case, which says that a bona fide sale occurs if you have a significant non-tax reason for creating a company. And so the potential headwinds against a bona fide sale are if the taxpayer is on both sides of the sale, if the taxpayer has financial dependence on distributions related to the business, or if there's a commingling of company assets and personal assets. And so you have to be careful about, if even in an installment sale, how that sale is set up so it looks like a legitimate sale to a third party under legitimate terms. Stepping away from just tax planning to also asset protection planning for a second, just talking about running a business and observing the formalities of a business. When you walk away from here today, my guess is that very few, if any, or probably none of you will say, I was at Dan Johnson's estate planning seminar in Westport this morning. Because we brand this as a Cummings Lockwood production, right? The invitation is from Cummings Lockwood, the materials say Cummings Lockwood, the slides all say Cummings Lockwood twice. It's amazing how many business owners break down the wall. I see it a lot with residential real estate owners. They own a building, and the people in the building, the contract is from them individually, even though an LLC owns the building. Rent is being paid to them directly and put into their personal account. That's not the way you run a business, right? The second thing, this is, I think, peculiar to what we all do for a living. When I send out bills for estate planning, estate administration work, probably 6 to 12 times a year, I get a check that's payable to me individually. Now, you can guess and assume I signed that check over to Cummings and Lockwood because I don't want to get fired. But again, I work with clients all the time who say, oh, should I have them write out the check to me or the business? my tenants. It has to be to the business. I mean, if you want liability protection from this LLC, you're not going to get it if you run this business like it's your personal bank account. And the same thing, and probably the biggest danger that I see in this area, is paying expenses. If I have a problem with my car, my partners are going to be sympathetic to me, but they're not going to say, "Oh, Dan, I feel so sorry for you. Here, take an extra distribution from Cummings Lockwood and use that to pay your repair bill." There is a bright line. I get paid a salary from my business, and it's up to me what I do with that salary, including paying all of my personal expenses. And so we have to make sure that our clients are observing all of those same formalities that we all observe within the context of our own careers. And then finally, the record-keeping function of a business. The concern here that I see is people who overly rely on their CPAs and or their attorneys to do cleanup at the end of the year. They basically, they run things through their personal accounts. They're not keeping careful track of expenses, and they're showing up with the proverbial shoebox at the end of the year saying, you tell me what happened during the year. And we have to convince them to do, the same thing we do on a larger stage at our business, have somebody who's monitoring the books on a regular basis. It doesn't have to be every day like Cummings and Lockwood, but at least once a month coming in and saying, what's happening with the business? How do the finances look? So it's very easy when you get into this business planning context to go out and find cases where things look and sound like a disaster. And it's usually some combination of what I've discussed. You have no respect for business formalities, a lack of recognition and planning for Section 2036. Sometimes the ice cream on the top is the bad facts, terrible facts that draw the attention of the IRS. And then they lead to these scary deficiency notices that appear in these reported cases. So in this case, estate of Edward Beyer, this was a $20 million deficiency assessed by the IRS. Actually, exactly, it was $19 million. It's an interesting case and on its face a scary case because it was a traditional installment sale. Mr. Beyer was an Abbott Laboratories executive. He had 800,000 shares of Abbott Laboratories. He took it, he wrapped it in an LLC, he sold it to an irrevocable trust that he created. Sounds like a lot of installment sales that we've all seen. But now let me layer in the bad facts. Mr. Beyer, when he engaged his estate planning firm, he was 93. When he engaged in the sale, he was 95. The entire transaction was orchestrated by his nephew, who was organizing his estate planning. The security for the sale, so it was a $20 million sale, so the security for a $20 million sale to a trust, what would we ordinarily say it should be? 10% of the value of the promissory note, so $2 million. The security in this trust was $10, the original $10 that the trust was funded with. So that's not a note that we would tell our clients that the IRS is going to respect. If you look at this engagement letter language, and this is the actual language from the law firm, basically this says we're going to do this transaction in a way that violates Section 2036. So that was not a good fact. There was terrible record keeping here. The income tax returns for the LLC that was sold were a mess. They showed members who were not members. They reported the interests incorrectly. They changed from year to year. They were amended. The distributions in connection with the promissory note were a mess. The distribution should have been business makes distribution to an irrevocable trust, which makes a distribution to Mr. Beyer. So 2 distributions to pay the promissory note interest every year. Instead, they were skipping a step, and it's actually a partnership. The partnership was making payments directly to Mr. Beyer, so cutting out the irrevocable trust. So it was making a distribution to Mr. Beyer, who was no longer a member of this partnership. And the nephew who's trying to organize all of this and said in an email to the law firm, I have to tell you, I find all these trusts confusing, which says 2 things. He should have had better advice or monitoring of this entire transaction so he didn't make those kinds of missteps. And the second thing that we should all take away from this, everything in this case was discovered. The engagement letter, communications between the client and his advisors. And so it's something everybody here should keep in mind when you're engaging in tax work, that potentially that work could come to light. So the conclusion in a race through succession planning is you have to help your clients work through the hard issues. You have to have the technical issues, particularly 2036, under radar. You have to mind your knitting in the documents, make sure they're consistent with what the client wants as you get into the transaction. Make sure that you follow all the steps that the transaction lays out so that it's more likely to be respected by the IRS. So I thank you again for your attention. Happy holidays, everybody.